I don't want you to spend money to get a write-off, but if you have to spend money, can we make it a write-off?
My number one expense is my mortgage, or my number one expense is my kid's tuition. And I say, no, your number one expense is likely your taxes.
The hard part with a physician of getting the new salary at a higher level and then getting bonuses that are going to be taxed is everybody thinks that the employer is going to withhold the right amount of tax. Not true.
Yeah.
Never happens. If your tax was 100,000 last year, you got to pay at least 100,000 in the next year if you're going to make the same or more. Yeah, so what? I got to pay 30, 40, 50% of my tax. I'd rather make $1 million, pay a half than make 200,000 and pay a third all day long.
All right. Hey, guys, this is John Apino. I am the principal and founder of Contract Diagnostics, and I get to hang out today with Glenn. Glenn Harper has Harper and Company, right?
Correct. Harper and Company, CPAs
And,
Plus.
yeah, CPAs Plus. And CPAs Plus means you guys do taxes. And I mean, at Contract Diagnostics, we spend all of our time helping physicians understand what their contracts say, and then of course we guide them on what they need to, what's relevant, what's important, what's standard, and then how they should go about discussing and negotiating their contracts. And I know that's not what you do. And when it comes to CPA stuff, I know that that's well above what I do here as far as our scope of knowledge. But I do always tell all of our physicians, I'll say, people look at like, what's your number one expense? And they'll say, oh, John, my number one expense is my mortgage, or my number one expense is my kid's tuition. And I say, no, your number one expense is likely your taxes. And I said, so just like you plan with everything else, you need to be very proactive in how you plan for taxes. And I, myself personally, I've always had a very proactive approach. I have a plan going into the year before we even start the year. I've been all of the things that are all of the types of people that you've worked with. I've been an employee, I've been an employee with a side gig, I now own a business and I'm paid slightly different. And I'm looking forward to catching up with you over the next 30 or 40 minutes or so on expenses and taxes and everything else. Real quick, just kind of walk me through you and your company and who you serve and everything else.
Absolutely. Thanks, John. The Harper and Company CPA Plus, the CPA by definition says we kind of know some things about compliance work, which is taxes and accounting, which is you get information, you punch it in, you get your result. You get a good financial statement, you get a tax return. But the plus is for what we call the advisory side, the how, the why, the shortcut, the value add, the knowledge transfer. That's where you're trying to educate and elevate your client, where it's about planning. It's trying to have some reasonable ability to predict the future, because it's not what you make, it's what you keep. And as you negotiate contracts, you want to throw in things that are going to be the employer paid perks. So the employee, if they're getting this contract, they don't have to pay for those malpractice insurance and all those continuing education. You negotiate that in the contract so the company pays them. So we don't have to pay tax. And heck, as an employee, you can't deduct anything, right? So as far as what the Harper and Company CPA Plus does is it's just try to help navigate the complexities of what you think you make and what you actually make, net of those things, of taxes, expenses, whatnot. And it's trying to get you in the best result where the amount you keep can be the highest possible. And then you can divert your income in different buckets to help get a better result the second time you earn the money.
Yeah. No, it's a super complicated process. And like I said, I think I've been through all those different situations that the folks that we work with, as far as employees or business owners or those have jobs that they have side gigs, and and I've always had a proactive plan no matter what it is. We work, the vast majority, Glenn, of folks that we work with are straight W-2s. They take a job at a hospital and they get a contract, and a lot of them now, I think they're more proactive. They want side gigs because they know that it could mean that they can make some extra money, and maybe they'll have some other deductions and they could do something else with it. But for a typical physician that we work with, I talked with one this morning already. He's a W-2 employee, gets paid on a W-2. They take out taxes. I don't have access to the physician's benefits yet. We'll request those from the employer, but I know that the contract mentioned something about a 401k, but I have no idea if there's a match, or I know that there's federal limits to a 401k. But walk me through how you would guide just a straight W-2 physician who's working for a hospital, as far as if they say, look, there's nothing I can do. All that I have available is this 401k for pre-tax and tax efficiencies when it comes to the planning process. How would you lead that physician through the process of planning for this year?
So the best part about this scenario is that it's managing expectations of the physician, because that physician has probably for the last 12 years not made any money whatsoever, got a huge amount of debt, a living, probably in a way that nobody would ever think they would have to live to, because they just don't have any money. And all of a sudden they magically get this job and they're like, oh my gosh, I'm making 200 a year or $150 a year, whatever the number is. And the average is, you can probably speak more to that, but let's just say it's 200,000 a year for an average physician coming out of med school, just basic. They think, oh my God, I have $200,000. I can, I'm making, 15,000 a month, 16,000 a month after I'm good. Doesn't work that way. So what our job is, what we try to do is to keep it real, to say to the client, to the physician, say, look, just because you got this job does not mean you're loaded yet. You've got a lot of old stuff you have to pay. And the tax man is taking things off the top. So the key is to say, don't go buy the new Beamer. Don't go buy the new house just yet. Don't go buy the cool stuff. Let yourself get caught up to where you can manage that cash flow. You know what's going on. So the first thing we try to do is get a feel of their budget of what do they spend at home, and what can they reduce or lock in, where this is the have to payments at home that I have to pay. Then we have, what is available.
You're saying the BMW payment is not a have to pay, and the $15,000 vacation is not a have to bucket. Okay, I'm joking, of course.
Still drive your Honda Accord that's got 300,000 miles on it, and just keep driving that thing till it dies, as long as possible. Even though you've worked really hard as a physician, you've killed yourself, you sacrificed everything, your entire life for 12 years. You just got to do it for a little bit longer, unless you get lucky. And it doesn't matter if you're making $150, 300,000, 500,000. It doesn't really matter what you make coming out, because if you don't set that tone at your budget at home, you will never have anything. The second you set that, and you can sacrifice for another 6 months to a year to kind of navigate what that looks like and figure out, hey, it's not about what I make, it's what I need. And then I change that goal to what am I capable of doing? And that would be, can you get bonuses? Can you do some ad locum work? What are those things that bring in the other income? Because that's where the difference is going to make you get to the next level financially. So when we do this, the first thing is to say, look, you're going to make X. The first thing is to understand that the tax man is going to come and take a big chunk, because there's really nothing you can do. And the only thing you can do is defer income. And so anytime you go to work and you have your first job and you get employed by a group or a hospital, whatever pre-tax perks they're offering you, take them all of them. Because what you can put away of your money is not that significant, but what the employer usually matches is pretty robust. And depending if you're private or you work for a hospital, whatever, always do the max you can. Now, sometimes that's impossible because your bills are just too high. You have to navigate that. But depending on how much you put away, depends what your taxes are. And depending what your taxes
when you're
are.
talking about, in this situation, Glenn, you're talking like a traditional W-2 that would have access to a 401k or a 403b or a 457, right, something similar to those plans.
Correct. And depending on your length of service or how long you're there and the rules and regulations for that particular group, you can participate or not participate. They'll put in money as the employer or not put in money. But generally, if you put everything you can put away in, they're going to match and put everything they can put away in. Now, whether that starts today or 6 months or a year, you just never know with the group you're involved in. But that's your first thing that you want to do, because now you set the tone that you're going to pay yourself first. And that's just taking money off the table. And the IRS pays you to put money in this other account. Literally, they almost give you a check because you're not paying the tax today. You kick that can way down the road.
Did they change like, I know it used to be you had to opt in to a retirement plan. I remember I read a couple of articles a few years back that were talking like, no, everyone's going to be auto enrolled. You have to opt out. Have they changed that, or is it auto enrolled? Or I don't see that in the contract, of course, but I don't know what the policy is. And if it's different per state.
Yeah, the Secure Act 2.0 changed a lot of the rules, but again, it's also based on the size of the employer you work for. When you get over 50 employees for who you work for, they have a whole separate set of rules that they kind of have to do.
Okay.
Under 30, up to 35 employees or so, you got rules. And then underneath that, you have a separate set of rules. So really, it's just having the conversation of what perks and bennies are available for you. And then you should participate. Pre-tax health insurance, do a pre-tax daycare if you can, dependent care benefits, do your retirement plan that you can do. If you have a health savings account option, you should check all those boxes. And what that does is everything you do there basically going to save you anywhere from 20 to 40%, depending on your bracket, depending where you're at. That's a nice rate of return for just checking a few boxes. Then you get your net amount left, and this is what I have to live on. You're like, oh my gosh, how am I going to support a family and do what I need to do? But if you just do that and live like you're still back in college, you're going to have a lot more money. I promise you, every time this happens, you can sacrifice for the next 6 months to a couple years to get adjusted. You will be working forward instead of always being behind, because you go buy the 2 new Beamers, the new house, and do your thing. It's going to take you forever to get caught up. You're always going to be behind. And that's just a horrible place to be, because you're already behind earning money because you spent 12 years in college. Now you're going to be behind on saving money. You're now behind and can't invest money. You're behind because you got to pay your taxes. Like, that's just, you don't want to spend your whole life being behind. So as a physician, just because you think you're making X doesn't mean that's what you actually have.
Yeah. Yeah. But these are just kind of general rules for everybody. W-2, or if you're on a partnership track, or if you're doing an independent contractor or a locums tenens position, those are just good rules. Or even if you're not a physician, those are great rules for everybody who's finishing training and jumping into the workforce, whether it's you're finishing high school or an associate degree or a college degree or an advanced master's degree, or you've been in training through a medical degree and now residency and or fellowship, and now you're out with all these student loans. Those are just good rules for everyone to live by. What are a few separate rules that you might say, this is for one person maybe who is paid on an independent contractor, and here's somebody who is paid on a W-2. So if you have a W-2, I think it was clear, take advantage of everything pre-tax that you can, from retirement accounts to health insurance to everything else. How would you lead a physician that we look at their contract and it says they're an independent contractor and the organization is in no way responsible for paying taxes or estimated taxes, and there are no benefits for this individual? And we obviously see differences in compensation sometimes. So an independent contractor, we would assume, would be paid quite a bit more than a W-2 employee. I think we all know that if you're not supporting a physician or their family on benefits, if you're maybe are not providing malpractice insurance, if there's no CME funds or allocated, paid time off, if you will, the employer's cost, if you will, is much less. And so generally we see those independent contractors paid more. But the contract doesn't get into all the nuances and the specifics.
No.
So what would that independent contractor need to know? I'm not a tax professional, but I know that what seems like forever and ever ago, when I left a W-2 job, if I was making $50,000 or $100,000 a year, if my W-2 job was paying, walk me through, there's all these different taxes. I would pay my federal tax, I would pay my state tax, I would pay a portion of some tax. And I remember my accountant said, well, John, your taxes are going to go up on this and this, but we have these options, which comes back to the planning. So walk me through what an independent contractor needs to know as far as what they're going to pay in excess that their W-2 counterparts don't. And then, of course, what benefits they would have as they go through that planning process for their most expensive expense, which is their highest expense, which is their taxes. That's
correct. So ultimately, when you are a W-2 employee, the IRS says you have to pay your taxes ratably throughout the year. You don't get, you just pay them at tax time and you're good on April 15th. You have to pay them as you make it. So in your W-2, you can pretty much predict, and that's your only source of income. You can sort of, hey, Mr. CPA, my advisor, here's what I'm going to make. What does this look like? Here's what I'm going to put in retirement. And you can calculate as a CPA and say, hey, based on all your circumstances, this is how much tax you'd be withholding every pay. And when you file your tax return, you're going to probably break even, $1,000, maybe get $1,000 back, whatever. That's the goal for most people that have, we call it real jobs. Okay. And in that situation, you really don't get to participate in the tax code. You're sort of like a victim of the tax code because it just is what it is. There is really not a lot of wiggle room unless you defer your income. The second you cross that line and you become independent contractor, self-employed, there are so many more different things available for you because now that's the way the tax code's been produced, is to try to say you're a participant, not a victim of. And the participant says, hey, when you're self-employed, people say, I can write off everything. Well, why do you need to write anything off? The question is, if you have to spend money to make money, that's a great thing to do because you're getting a return on that. And we don't want you, if you're going to make $100,000 a year as an ad locum and say, I don't want to pay any tax on that income, great. You can pay us $100,000 a year and we'll get your income down to zero. So you don't have to worry about paying any tax. I make that joke all the time because wait a minute, I don't want you to spend money to get a write-off, but if you have to spend money, can we make it a write-off? So that just comes to the education, and the education of the client is that ordinary, necessary, reasonable, and your intent for a particular deduction does it count. So when you're an employee, you can't deduct anything, literally. When you're an independent contractor or you have a business, you can deduct some things. And at that point,
I remember years ago, Glenn, when it was the tax season, and my accountant, I said, what can I do? I owed money. I said, what can I do? She goes, well, you can go buy, you know this better than I, but there's a certain rule, what's considered a work vehicle or a truck. Correct. If it's over a certain weight limit or a certain price. And she goes, I think she recommended I go buy a expensive truck. I think she mentioned I could buy a Range Rover or a really high-end Hummer. I think they were making them back then. I don't remember. And I drive a Toyota. I love my old Toyota. And I said, I don't need one of those. And she says, well, then you can pay your taxes. And I paid the taxes because I didn't feel the need to buy a vehicle that I couldn't even afford, just so I could skeet out on a couple of taxes. So.
And to that point, it's really about the conversation. It's something that you shouldn't be having that conversation on December 31st, and you certainly can't have that conversation on April 14th. It's something that you would have throughout the year, and that's where the planning comes involved with you. When you work with your CPA, you got to have a plan because you want to predict things and you want to work proactively because there's so many things you can do when you're self-employed. But the main thing is when you get this secondary side income, it does open up some doors of things you could write off, but you write off the specific insurance for malpractice for that particular thing you're doing. Can you write off your cell phone for that particular piece? Can you write off maybe a home office for that particular piece? Can you write off some mileage? Can you write off, some meals perhaps? All those things come into play, and it's just having somebody teaching you what you can and can't do, because what people tell you can do and what you can actually do are so different, because they'll say, well, Dr. Bob says that he's doing this and this. And I'm like, well, Dr. Bob has a whole different circumstances than you. So you don't get to do that, but you get to do these things. And that's just the conversation. And ultimately, when you do have side income, again, just know that if you are a typical physician, it's highly probable that you're probably going to be in close to one of the highest tax brackets there are. It's just the way it is. I mean, you're going to jump in the high bracket once you hit you're in the 35% bracket once you hit about $243,000 of taxable income. Well, if you're making $200,000 on a real job and you have $50,000 in every dollar you make now, you're giving $35 to the feds. You're giving an additional 3.8 to the Medicare. You're giving, say, 5 to 10%, maybe 11%, depending where you live, to the state. You got city taxes you got to pay. So you're losing about half of what you make. So you just mentally, as a physician or any entrepreneur, you just got to realize that when you start making other money, half of it's gone. So now how do we mitigate that half? That's the starting point. You're going to pay about half. Well, how do we make that less? Well, can we write off some things that you otherwise would not be able to write off as a real job, but now you're self-employed, you can? What other retirement plans are available? How do we bring in our income shifting by perhaps paying our kids, or can we pay our spouses something? Maybe we can set up a different retirement account that doesn't count against our 401k or 403b on the side for a real job. And all those things are on the table. Now, we can sit here and talk for the next 300 years and still never get through every deduction that's available. It's more of a concept, not a specific. So as the conversation with your CPA advisor, with your client, that conversation will bring those things to the table. Hey, I heard about this. No, yes, no, yes. What about this? And we can get down a path where most people get to do these things. And whatever those things are, if you qualify, you get to do it if you want. If you don't qualify, you don't get to do it. But believe it or not, most people spend a lot of money for business expenses that they don't even, just in their day-to-day life, they don't even realize. And so we want to try to capture those to offset that side income. All right.
And that's only available to side income. So if I'm a hospitalist at a facility, I make $300,000 a year providing services, 7 on, 7 off. And I have my 401k is maxed out, and they give me $3,000 for a CME for education, for a conference. If I spend $5,000 on a conference, they reimburse me $3,000. I can't do anything with that $2,000 as a W-2. It's not looked at as a job expense. I can't deduct anything else with the way that my taxes are done on that W-2.
No, you just have to eat that. And so we call that an unreimbursed employee business expense. Back in the day, you maybe could deduct that if you got over certain limits and alternative minimum tax didn't kick in. But the TCJA that we did in 2017, the new tax law, we're under the rules still right now, you can't deduct that. And again, I look at it, and this is where you come in, why I think your service is so valuable, is that you recognize that some of these employees are going to have these expenses. If you can negotiate in that contract where the employer will reimburse up to that amount, that really saves the burden. You shouldn't have to go to work and have to spend money to make money on a real job. They should cover that. When you're self-employed, that's just the nature of the business. You have to spend money to make money. So those deductions are available. But we would try to say that your goal with your physicians is when you're negotiating contracts is to say that they're Switzerland. They're neutral on their spend to do their job. And then after that, now we work on what can we do from a tax standpoint. It just is what it is, and they make money. And remember, everybody pays money the first time, generally, unless you can defer it. Then the key is, this is how you acquire the wealth, is the second time you make money, and your interest, dividends, capital gains, real estate, side businesses, whatever those things are, how do you not pay tax the second time you make money? Or how do you defer it? And that's the key here. So as you're trying to navigate this as a physician, you got to be patient, because most physicians are hardworking son of a guns, and they are going to work 1,000,000 hours. The money will come. Just don't get behind, because you want to work toward opportunity, not because you're behind and you got to pay your bills. And if you can change that mindset where you know what you have to spend, have to make a living, and then the rest of the money after tax creates this gap, this delta here that says, this is opportunity money. I can invest this somewhere. I can get a real estate deal. I can start a business. I can throw some money for friends. Please don't buy a restaurant or bar. Those generally don't work out well for physicians, because physicians, God love them, they're awesome, but they always have a friend that says, hey, you're a doctor, you're loaded, give me some money, I want to start a business. The first step is to probably say no to that for a little bit until you can get that properly identified and evaluated before you start throwing money to that. Because again, we all know that when you invest money on the side, most of the time it doesn't work. A lot of times it does, but most of the time it doesn't. So you can't afford to lose that. We call the investment in the entrepreneurial world and side businesses legalized gambling. Like, you're taking a chance on somebody, you're putting the money there, you have no control. They're going to do what they do. And if they're not good at what they do, you're probably going to lose that money. So don't gamble that unless you can afford to lose it.
Yeah. Let me ask you like a question that we hear a lot here. And this was part of my conversation with a physician this morning. So we have, so physicians oftentimes they receive a signing bonus. Mm-hmm. And we talked earlier, of course, when you get money, you pay taxes on it. And, if I wish I had a few bucks every time a physician said, John, do I have to pay taxes on the signing bonus? Or how do I not pay taxes on the signing bonus? And I've said, I can connect you with a lot of really, really smart CPAs, but I think if the employer gives you money and they document with the government that they gave you money, which they will, I don't know that you're going to get out of paying any taxes on money that's given to you by your employer. And a physician may get a signing bonus, let's call it $40,000. And let's say that they are given the signing bonus today. And my contract says I need to work 2 years or I need to repay, say, a portion of the signing bonus. And there might be an interest rate that's tied in the contract with it. It might be prime plus 1%, or it might be defined as 8%, but it might be defined in the contract as a certain percent for a loan as it's forgiven. Because there's obviously, I guess we should go back. There's multiple ways of doing it. We can give you the full 40,000 now, and we can forgive it over 2 years. So 1/24th of the 40,000 will be forgiven every month. So that's a different situation than if we give you the signing bonus up front and we just hit you with the taxes, and then if you leave, then you'll have to pay us, the entire thing back over 2 years. But in both those situations, there may be taxes paid up front. So let's take the one where a physician gets $20,000 or $40,000 today. It runs through payroll, so it's a commencement bonus. So they run it through payroll. They take out 401k. So of the 40,000, how much do you think would be left if they maxed out their 401k? Whatever they could have.
So I think that, again, that depends on what bracket they're in. But generally, forget about the repaying back and that part. Let's just look at getting the bonus. So the hard part with a physician of getting the new salary at a higher level and then getting bonuses that are going to be taxed is everybody thinks that the employer is going to withhold the right amount of tax. Not true. Yeah. Never happens, especially if you have a spouse that's working as well, because the two payroll systems don't talk. Your payroll system is the doc, your spouse's payroll system. Good. He or she could be a doctor too. It doesn't matter. Whatever those two careers are, they don't know about the other income. So guaranteed 100% of the time you're going to be under withheld. So as soon as you get that first paycheck and you see what those withholdings are, it's incumbent on you to grab your advisor, CPA advisor, and run a tax projection and say, where am I at if this is what I make for the year? Oh, we're going to be short $10,000. We need an extra, whatever the number is, $800 a month. That has to be extra federal withholding, whatever the state withholding is, to adjust it. We don't care how you get there through the taxpayer, the spouse, or combination therein, but to say, how do we end up breaking even? Then if we get the bonus, the same thing happens. A lot of companies will withhold a higher rate on the bonus, but it's still probably not going to be enough. So if the bonus is happening, we just have to know so we can prepare for it. Because there's two factors, right? We're going to owe the money by April 15th. We have to pay a safe harbor amount of tax in by the December 31st of the year. When you make the money, it's based on the prior year, that you got to pay at least 100% of your money, give or take. Some is 110, 98, whatever. You figure 100% of the prior year's tax you have to pay in. So if your tax was 100,000 last year, you got to pay at least 100,000 in the next year if you're going to make the same or more. You still could hit the lottery on December 31st and owe $400 million, but you won't get a penalty. So the first thing is to trying to say, here's the minimum you have to pay to get out of trouble. Here's what you're ultimately going to owe in April. You're aware of that. Would you like to pay that now as you go, or set it aside and pay it later? It's just communicating to the client. So they think they have this check. In your example, they get 40,000 bonus and they would get, probably 30,000 in their net. And they think, I got 30,000. You don't have that much. So what do you really have? So it's about dealing with real numbers, not fake numbers. And fake numbers, what you think. Real numbers are like, hey, those have been verified that this is what the number really needs to be. And that would be the conversation.
Yeah. And if you don't pay, so let's just say I wing it, I have 40,000 in my of a signing bonus, and I start and they send me a check for 30,000. I have no tax advice. I'm going to do it myself, or I'll figure taxes out when I get everything at the end of the year. I have no plan, so I get the 30,000, and let's say I should have paid an extra 5,000 in taxes. Mm-hmm. So since at the end of the year I'll make up for that, the downside to me for not settling up sooner is a penalty. Is that right?
Well, believe it or not, the penalty is just really irritates you when you have to pay a penalty, because it's just an evil thing to have to pay a penalty and interest. But that's really not the crucial factor. Crucial factor is you're running your household and yourself on a budget that you have enough money. All of a sudden I come to you and say, oh, by the way, doctor, you owe $5,000 and you didn't expect it. That is life-changing. That will ruin you, because you were saving some money for something else. And now we got to go pull that money and pay the tax man because you thought you had that money. The mental stress that puts on somebody is horrible. So it's the surprise. It's not the amount, it's the surprise. And so if you can hit a client up front and say, here's the number you're going to owe, and they're mentally prepared for that and they earmark it, then the client can go do what they need to do and not worry about the tax consequence, because you adjusted it at the front. So that's really the kicker. The penalty, they're going to charge you a $500 penalty, $700 penalty, whatever the number is. Yeah, that sucks, but that's not really the point. The point is the surprise of now I owe taxes,
Yeah.
and nobody
Smoothing
likes that.
out cash flows.
Yeah,
Yeah. Okay.
nobody
So,
wants that.
so, so I have, let's say I'm a prepared physician. I get my $40,000 check and I call my CPA and we're talking through it and I send him a couple extra bucks so I don't have to worry about that now. Or I just call my HR department and have them adjust my withholding for the rest of the
Right.
year. So I make sure that I can spread it out over a long period and smooth those expenses out, like you said. So as I work for 2 years, the amount is, I don't have to pay it back if I work for 2 years. But let's say that I decide to leave my job in a year and it was 40,000 for 2 years of guaranteed work. And maybe I have to pay all of the 40,000 or maybe a prorated share, but I definitely owe money back to my employer when I leave. There's usually an interest rate tied to it. I have already paid taxes on it. So whether it's the 30,000 or whether it's, the appropriate amount, what is the amount that I'm going to have to pay back to the employer? Because we get questions all the time on, well, I've got to pay money back. And of course they gave me, I had a $40,000 signing bonus, but I only got 30. So I only need to pay back 30, right? And that's a tax question. I say you need to make sure that you connect with the tax person on, because I don't know exactly how the tax code works and maybe it's different per state. I'm not sure, but walk me through a money that I would need to repay as I'm leaving a position on items that I've already paid taxes on, such as a signing bonus.
So it all depends. If you're self-employed, you can generally deduct that money when you give it back because you're kind of refunding your fee. If you're a W-2 employee, it just depends on the contract or what that looks like. But generally, when you make money and you pay tax on it, and it's really an advance, if they counted that as income to you, you're just kind of stuck. If it's a slow bleed, they give you the money today, but sometimes in this case they'll give you
tax it over time.
Yeah, they'll give you 40,000 today. Then they'll say, hey, we're going to give you a W-2 that says over 2 years we're going to give you 20 grand of income this year, 20 grand of income the next year, and we'll throw some interest on there that you have to pay, and you dole that over time. So if you leave after year 2, you didn't get taxed on the other 20,000, you would have to give that back, but there's really no tax consequence per se because it didn't get counted as income. If they give it to you all as a bonus and income today, you're kind of stuck. You got to pay that back. So depending on the circumstances, you probably aren't going to be able to deduct it. And I'd have to look at that specific contract to see how that would be treated to you. But yet it's a tricky one.
So it would be better, most likely, then to have a signing bonus set up as a forgivable loan that's forgiven in equal installments over the time frame of the account, of the contract. So if they had a 2-year agreement for the $40,000 in our example, a better tax scenario would be forgiven the 40,000 in 1/24th chunks, get the 40,000 up front, and then be forgiven the amount 1/24th over the 2-year period, where you wouldn't have paid taxes on it to begin with. Does that sound right?
Well, it could go that way, but we've seen some crazy things come through where one of the big deals now is if you're a physician, you come and work for a group, they'll pay your student loan, a certain chunk. And I've seen it. Yeah, I've seen it give it to you as W-2 income as a bonus. I've seen them give it to you as a 1099 independent contractor income. And they bleed that off over time, and you're allowed to deduct expenses off that. You can put that in retirement because it's earned income. It just paid as a different way. So this is where, as you representing your physician and you're trying to get in and work with this group, is to decide what does this look like and what's the most advantageous, where your client is this physician. If they get the money, they get to keep it. And sometimes they'll dangle that carrot in front of the physician. Oh yeah, here's your money, and we'll do this for employee forgivable loan. You got to stay on for 15 years. Like, what is the actual number they have to stay? Where they're basically an indentured servant, because if they leave, they got to pay it back. So that's just the negotiations to see what they're willing to accept. Because sometimes somebody's freedom to ability to not give me money that I'm going to spend, and now I'm beholden to you, and I have to stay somewhere I don't want to stay, because if I leave, I got to pay all this money back. Sometimes it's better, don't give me the money, let me be free and do what I need to do, and we'll negotiate on the next contract for a higher salary where I don't have to repay it back. And I think that's probably one of the things you do for your clients, is to help them figure out what does that look like, because don't get in this situation where you get lured with all this. They're going to anoint you with all this money, but the fine print says they own you. And as a doctor, you probably don't want to be owned like that.
Yeah, we've guided a lot of physicians to declining certain
Hmm.
incentives paid by the employer because they didn't want that to happen, or by most employers think that I'm going to call the physician's going to call and request higher salary. We've had some physicians based on discussions because again, just like you said, it all depends. Everybody's tax situation is different. Their situation, employee, if their spouse is working, if they have kids, if they're moving around a lot, there's so many different dynamics to every tax tax client of yours, and that's why you have to have a customized plan. You can't just purchase one off the shelf. Same thing with our folks. All of our physicians have a different, unique perspective. Some want to work somewhere for 1 year. Some, think they might be moving. They don't know if they'll be moving. Some the employer may have shifts in their policies. There's always consolidation in healthcare, and contracts are always shifting, and compensation data is always moving. So every situation that we have is a unique individual perspective as well, which is why we customize our approach, much like you do for your folks.
And I think
But as I
I
yeah,
was going to
please.
say to that point, it's again, it's not what you make. It's the devil's in the details. What does it look like? How much do I get to keep? Am I beholding for something? What bracket am I going to be in? What are the perks and bennies available? It's having an understanding. And again, as a general rule, I could probably pick up brain surgery and a couple chat GBT things and do a couple classes online. I could probably do it myself, right? What's the worst that could happen? It would be
Sure.
horrible. Well, if I'm a
Yeah.
doctor, I'm not going to know the tax code. I'm not going to know contracts. So as a rule, hire the people around you. You're at that level where you should be hiring people to help advise you to get your best result. You just got to check those egos at the door, and it's about putting yourself in the best position, and you hire the people where they're working with you proactively through your whole journey, and you will get a way better result than if you try to do it on your own or listen to Bob over down the street because Bob doesn't know your circumstances. He just doesn't
Yeah.
know.
Well, and it's a great point when we have a lot of physicians that will ask, do I even need to have the contract reviewed? It's non-negotiable. Or the employer told me it's non-negotiable. And as you're talking about that, I keep thinking the tax code's non-negotiable as well. I
Nope.
mean, I can't call the federal government or the state government and ask for, some changes on my tax code for John this year. But it doesn't mean that you shouldn't ask a lot of questions. It doesn't mean that you shouldn't have a proactive plan. It doesn't mean that you can't navigate the process with the right guidance to be the most advantageous. And I think it's a really good analogy. Again, lots of physician contracts, the majority I feel are negotiable and willing to accept changes depending on what the change is. But for the folks that are out there that think maybe my contract's non-negotiable or the employer told me it's non-negotiable, don't even have it reviewed. I think it's similar to the tax setup. The tax code is not negotiable, but to have a proactive plan so you're paying 22% instead of 27% is really important. Even though the difference between 22 and 27 wasn't the result of a negotiation of the tax code for an individual person, it was just being aware, having the right questions asked, and then having a plan moving forward to ensure you're taking full advantage of the system as a participant, right?
And remember, there's nothing wrong. I mean, there's a lot of things wrong, but if you make money, generally you're going to pay tax the first time you make it. And that's just the way it is, especially if you're an employee or anything in that type of thing. So the goal is to make as much money as possible. Who cares if you're in a higher bracket? Who cares? Yeah, so what? I got to pay 30, 40, 50% of my tax. I would rather keep 50%. I'd rather make $1 million, pay a half than make 200,000 and pay a third all day long. And generally the physicians, their mindset is they have proven that they're willing to work. They're good at what they do. They believe in themselves. They're investing in themselves. They're not going to go work 8 to 5. It just isn't going to happen. They're not programmed that way. They are going to go and earn a living, and they're good at what they do. So they are going to get compensated for. Your job is to help. We need physicians. The market's all out of whack on who's making the money in the hospital, right? Administrators make more than the surgeons. It's all strange right now. There's nothing wrong with it. Everybody gets what they can get, but you're an advocate for the docs. The docs need to know their worth, and they got to go and try to execute on that. And once they figure out what they're really going to make, now we figure out what they're really going to net from that. And then they see if that's going to work for them. But they should always negotiate for the most amount of money, most amount of perks.
Absolutely.
And try to, it fits their lifestyle, because it's all about opportunity, right? The money will come. It always does if you're good at what you do. And if you don't get locked into a long-term contract and you can get in where, you can negotiate with certain perks and, matrices that you hit that will give you bonuses, that's a wonderful thing to be in. So that's really where the action is.
Yeah. Do you think for the physician that's going to be a W-2 employee, do you recommend that everybody tries and accepts some sort of side work, whether it's for, $3,000 for the year or whether it's, $50,000 or $100,000 a year? Do you think everybody should try to have a little bit of 1099 side income so they can participate a little bit more in the tax code?
That's a trick question. And the reason it's a trick question is because there's a certain amount of worth that one would have for their time. And the worth says, well, if I'm going to go work Saturdays at an ER department or an on-call facility, or I'm, as an anesthesiologist or whatever that looks like, and I'm going to go put in my 10 hours over there and I'm going to make $3,000 and I know the government's going to take half. Is that extra $1,500 that I make, is that worth it to me for my time and value to do that? Most doctors can't sit still. They're going to want to go to work and do something. So now it's about, you go out and you start doing those things. You're going to start meeting more people. You're going to start building your network. You're going to start finding the gigs that it's about your quality of time and what you get paid versus your quantity. And so the answer to that question is probably yes. You should always try to have a hustle and a side gig because yes, you can write some things off. Yes, you have some things you can do, but you're just trying to make more money and you're trying to increase your ability to be known and to be in the marketplace where people know who you are and they might want to hire you for something specific where you're going to make a ton more than what you already are. And that's it's the opportunity is what it is.
Yeah, I think I look at it as twofold. One, it's good to diversify sources of income. If 100% of your family's income is on you and you have 100% allocated to one position, a lot rides on that W-2 position. And as a W-2 employee, no matter what industry you're in healthcare or otherwise, it's a lot of faith to put in one organization is 100% of your family's, your family's income. So I always tell people it's good to have diversity, even if it's just a little bit. I agree with you. I think it's good that people get out there, get to know more people, stretch themselves. Now, I will tell people who are looking for side gigs, medically related or not, it's important to make sure that your contract lines up, that you're able to do those things without getting permission, because we see a lot of contracts that say you can't have any type of income outside of this job. And it doesn't say specific to healthcare. It doesn't say specific to being a doctor. So, if they wanted to partner with their friend, like we talked earlier, and open that pizza shop, I don't even know if they could without getting approval from their employer. And others are more specific, like you can do lectures for the pharma companies. You just can't do patient care. But I think it's important that everybody looks at their contract or calls us and we can do it for them to make sure that the outside activities are okay with or without approval in or outside of medicine. But let's say that you have that position, they have the W-2 and they have that extra side gig and they make, a couple of dollars, a couple of $1,000s per year. I know we talked earlier about like expenses, what can you deduct? Maybe I can't deduct the wine club membership for my country club membership, neither of which I have, by the way. But if I did, maybe I couldn't deduct those. They wouldn't be considered a reasonable or customary expense, but maybe that's something that would be in different CPAs plans. But now that I have access to 1099 income, either because I have a W-2 or I'm a solo 1099, what kind of, let's say, retirement plans would I have options for outside of my company-sponsored 401k?
So that question is a loaded question, and there's a lot to unpack there. But the first thing is the reason why we're working more. Are we working more because we need disposable income? Like we're short on our monies for a household to support our family. Okay, if we're short, then we're going to need that money and we have to use it because we got to pay the bills and they're going to shut the water off, whatever, we have to do that. Generally, after a couple of years, that's not the case. As long as you don't have a spending problem at home, you will have disposable income. Now the disposable income says, okay, I have some disposable income. Now, where can I divert that? Whether that's an IRA, do a SEP, there's all kinds of different things you can do. You may or may not be able to deduct your IRA, but you can put money away. You might be able to do a Roth. You can always probably do a SEP, but is that the right thing to do with your money? Don't know that answer until you look at the client's specific circumstances, but it's about creating the opportunity where you can make this money, kind of not pay tax on a chunk of that, and you can deploy that money somewhere else that you're going to earn, we call the mailbox money, right? Where you can earn money by not doing anything. And that might be, hey, I'm going to get in some real estate. I'm going to start a new practice. I'm going to work for another doctor on the side, and I'm going to start building this practice, and we're going to ultimately go on our own and start our own practice. I want to be involved, and we're going to have the surgery center K1. We're going to have our real estate K1. We're going to have our management company K1, where these are all different businesses that we're involved, because now we have disposable income, net of tax, that we can deploy into these different entities to try to generate a rate of return where we're really not doing the work, but we're getting paid on it. And that's kind of the ultimate thing for a doctor, because you're already behind, because you don't start work till you're what is the 12 years that we're not starting till we're 30, 32. So we're not making really money. If you're like a specialist, like I think I read the neurosurgeons make the most, which is crazy. Who knew a brain doctor? And I was just joking that I could do that myself, but they make the most. But you probably have to go to school for 16 years for that to be good, right? So now you're 34 for even start. You're not even starting your family to your mid 30s. So your runway of how long you can make money is way shorter than somebody who goes right out of high school into working somewhere. So you're trying to make as much as possible, defer so much in retirement, and then deploy as much as you can into some other endeavor where you're going to get paid more money based on your operations and your ability to think and put a team together and be in those things that other doctors are, where you get paid. You don't have to go to work to get money. It kind of just happens. We call it mailbox money, right? So that's what you're trying to get to. So yes, anytime you can do that, you have to make that decision to live on, or are we going to deploy it somewhere else? And if you're deploying it somewhere else, that's just identifying good opportunities, right?
No, it makes perfect sense. Is there an ideal situation from a tax perspective? Like, if a 100% W-2 employee, solo earner, and in a family, I don't want to say worst, but maybe that's like the most restrictive. Is there a situation where somebody would have the most flexibility and the most options to them from a tax perspective?
I mean, if you can be, again, it's a lonely place to be a solo practitioner as a physician, and you are in charge of your billing, your practice manager, your staff nurses, your customer service, your payroll. You have to do it all. It's a very encumbering thing. If you have the right team and you can get to that level, you can be very successful, but it's based on you. So generally it's going to be, you can hire other physicians to work for you, or you become a part of a group. You can then kind of share those expenses with somebody else, and it doesn't have to be all you, because generally doctors, or most doctors, lawyers, accountants, whatever, they're good at their task of being a surgeon or a doctor, but they're not good at being a business owner. But that's okay, because if they're good at their task and they can empower other people around them that are giving them good advice to teach them how to be an entrepreneur or a business owner, that's where the value comes in. That's what you're trying to accomplish. Because when you are in control of your own destiny, that's when you really make the big money. Now, there's nothing, I think I read a stat that the top 1% of physicians average $4 million a year. This is, of course, a couple-year-old statistic. The top 1%. 25% of physicians make over $425 a year on average. So if you're really, really good, the money's going to come. It's just what form is that? You could be a W-2 at a hospital and make your $4 million a year if you're really, really good. You could you own your own business and make $4 million a year if you're really, really good, but it's going to cost you a lot of money to run that machine. So it's about evaluating the options and deciding, do you want to be in charge of your destiny as an entrepreneur, owner, and part of a group where you have a seat at the table, or are you going to be an employee where you have to negotiate your contract every year or every couple of years, and that whim they can kind of control your destiny? So it's really just a different mindset. There's no right or wrong. There's no better or worse. It just depends on how you're programmed as a doctor, what you'd rather do.
Yeah, no, it makes a lot of sense. And I don't know, any predictions on what you see will change over the next few years? We saw it used to be a lot of self-employed, a lot of, solo practitioners. And then, of course, we've seen lots of consolidation in the past 10, 20, 30 years. And then we were seeing, 65, 70% of people physicians signing with hospitals for W-2 roles. And now we're seeing, I think, a little bit of a switch back to the old ways. We talk to a lot of physicians who really want to have, 1099 side work and that type of thing. I read a lot of blogs, and people are wanting to do real estate and investing on the side. Any predictions for a typical physician over the next 5 years?
You know, I'll probably get some heat for this, but I don't know who would want to go and be a doctor, and I don't know who would want to be a police officer. Like, you can't win at either one of those. You literally have a target on your back. You're always being under the microscope, overregulated, and if you make a mistake, you're done. So it's a really hard career to be in because you're so micromanaged, and you have a little bit more freedom if you kind of have your own shingle and you're kind of doing your own thing. You're still under regulation, but you can control that a little bit more. You don't have to have somebody with their thumb on you. And so the pendulum keeps swinging back and forth. You're right. The solo practitioner, it's just hard to do that because you take so much infrastructure. But now with artificial intelligence, you can offshore a lot of the things that you're trying to do as far as billing and receivables and those types of things. It is becoming a little more affordable now to be a sole practitioner as a physician, and you can go do that specially. So it's going to keep going back and forth. Who knows what the market will dictate, what that looks like, but the opportunity is always there. It really comes down to, as a physician, if you're really good at what you do, and your patients, and it's really the referring physicians believe in you, they will send you the business. And you can pretty much be your W-2. You can be your whole self-employed person. If you're really good, the business will come. And then you just have to decide, I'm part of a machine at the hospital and I'm going to make a lot of money working in this environment, or I'm going to be a superstar entrepreneur and I can control these other things and I will put together my killer team to make that happen. And either one is okay. The marketplace has definitely changed, as you can attest to. What you're doing today probably didn't even exist 10 years ago to the level that it is today. I mean, it used to be just come on and work and you're fine. And now you have to have these, 200-page documents just to go get employed, right?
Yeah, I've had lots of interesting conversations with older physicians on, I've never had a contract before, and this is interesting.
Handshake guy.
I don't understand this thing. It's pretty funny. Yeah. Last thing before I've got to run, and I've had a blast talking about how you guys could benefit our clients from having that plan. I know I have a proactive plan every year with taxes, and I feel everybody should, whether you're a W-2 physician or a partner in a large group, or whether you're not a physician. I think having proactive approach to your biggest expense is very important. But is there something that at the end of the year that you find to be a challenge when it comes to working physicians specifically? Is it they think they paid too much, or they think that there's more deductions, or they're not properly prepared with their documents and their return? Is there any specific challenge that you see that comes with physicians from a tax perspective?
Well, it's not just physicians, but they are notoriously this way. And again, it's a stereotype, but it doesn't have to be, but they're so busy, right? And listen, I screw up on your taxes. We owe a little bit more interest and penalty and tax. Who cares? You screw up as a doctor, somebody's going to die. I mean, let's evaluate what's more important. But what has to happen, if you don't take time as a physician or anybody else to evaluate with a professional where you're at, you are going to for sure be in a situation where you're going to have to be in a panic situation where you have to come up with money and you're going to get a not favorable result. So the key is having those conversations throughout the year, and it should be a gradual progression. For our clients, we have, hey, here's the things we're going to talk about at tax time to kind of set the table, what's going to happen in the mid-year, and hey, toward your end, this is what we want to do to try to make sure you're executing on your, harvesting all your tax losses, getting all your charity done. Are you going to do a donor advised fund or do it a little bit at a time? If you have a different practice, can we do some SALT payments to make it so you can deduct your state and local taxes versus having to eat it? What are the things that we can do? Can we put in a retirement plan? Have we maxed out your retirement plans, all that are available? Should we put kids on payroll? Should we pay all those things? That's kind of like we kind of work on that throughout the year. So really, it's just having a good relationship with your CPA to ensure that you're making sure you're checking all those boxes, and it's not a crap shoot at the end of the year where everybody's busy and we can't connect because it's December 29th and I can't do anything anyway. So that's really the big thing, is have those conversations really and have that relationship where you can execute on those things to try to, if you don't plan for the good results, you're just going to get what you get. And that's just not a great way to go through life at this level.
Yeah, I mean, with everything, I always talk about being proactive instead of reactive. And I mean, I bring up, of course, contracts. I'd rather the physician, even in a non-negotiable contract, I'd rather them know what it says up front.
Correct.
Instead of, now I want to quit. Let's go back and look what it said. Even if it was non-negotiable, maybe you can't quit. Maybe you do have to pay money back. Maybe you do have tail insurance or a non-compete. Those things need to be proactively understood, negotiable or not. And it's, like I said, having a proactive approach to your taxes is something that's super important.
Yep, knowing the rules of the game, right? Knowing the rules of the game.
Exactly. People know where they can find Contract Diagnostics. They search us online, contractdiagnostics.com. They can email info@contractdiagnostics or call the number, and Jan will gladly answer. How can people connect with you if they want more information on that proactive approach to their planning, which I recommend for everybody?
Yeah, we're on the web. I heard Harper and Company CPA Plus. You can find us that way. We're on Facebook, LinkedIn, all those cool places. If you search, we'll come up. We're in Columbus, Ohio, but we work with people all over the world, so it's kind of exciting. And again, it's the ideal client is one that wants to understand and work together, not just use this as a compliance tool to just prepare a tax return. That's not how we do it. We want to work with the clients that are having some situations that they need this kind of advice. And especially maybe the first couple of years, they need that advice up front. And then maybe they just need some tax prep going on. We have workarounds where we can help them with that. But eventually they're going to graduate where they're going to need a lot more robust planning. And that's the fun part, right? It's not granting out a tax return is not fun. It's advising a client where the action is.
No, sounds great. Well, hopefully we can hang out again. I'd love to talk more about cash balance plans and those donor advised funds that you mentioned, and
great
captives
stuff.
and kids on payroll. I know we mentioned it, but we didn't get into the weeds, and I'd love to talk about those things a little bit more. I have a very proactive approach here. I'm far from doing it perfect, and I know it always changes, and so I'd love to hop on and do another call. But it was as always, Glenn, it's great hanging out with you, and I appreciate your time.
You bet, John. Thank you. Appreciate it.